If you're placing your stop loss below a random candle or based on a certain dollar amount, you're basically blindfolding yourself, walking straight into a traffic and hoping not to get hit. In today's video, I'm going to show you the best way to set stop losses using support and resistance, as well as what I call the liquidity trap method, so that you stop being the bait and start trading like a pro. Let's get into it. If you're new here, my name is Houman, and I went from working in the Silicon Valley to building a 7-figure e-commerce business to now becoming a full-time day trader. And this channel is all about documenting that journey and sharing everything that I learned along the way. So if that's something that you vibe with, definitely go ahead and subscribe to the channel and join me on this journey. So the first mistake that traders make is that they put their stop losses based on how much they're willing to lose. So for example, they would enter a trade and then they go down $200 or $300 and they put their stop loss right there in a random place. So what happens is that the market doesn't care about how much you're willing to lose, right? It cares about levels. So a lot of time what happens is that price comes down, liquidates that level, and ends up going in the same direction. The second mistake that traders make is that they put their stop losses below a random candle. Now that could be an area that the price bounced from previously, or it could just be the previous 30 minutes or the 15-minute candle. So again, what happens is that price comes down, liquidates that level, and ends up going in the same direction again. Now, the biggest issue with both of these methods is that the trader is not taking into account the trap. When the price moves, it doesn't just move randomly. It hunts. It hunts traders like you who put the stop losses in random or predictable places. So if you're not factoring in the trap, it means that you end up being the trap. One thing that helps me is that I always remind myself that the market is a neutral place. It doesn't care about you. It doesn't have any feelings. It's just doing what it's designed to do, which is to hunt predictable liquidity. Your stop loss should be in a place that if the price ends up reaching it, your whole trade idea is invalidated. So it shouldn't be based on your comfort level. It shouldn't be based on a random candle. Your stop loss is your line in the sand that if the price ends up going there, the whole trade idea is gone. No matter what time frame I'm trading, the three most important questions that I ask myself is, number one, what is the daily bias? What is the direction of the market? Number two is, where is the support and resistance? And number three is, where are the traders getting trapped? Now I want to go through a couple examples. Now these are from yesterday. I'm not going to cherry pick them, pick something from 6 months ago, 1 year ago. These things literally happen every single day. So I'm going to go through the 2 trades that I took yesterday and show you exactly what I saw. The first thing I always do is I always look at the daily chart for my overall bias. So coming in yesterday, I'm going to go ahead and replay this. This is what I saw coming into that Asia session. So we saw that there was 2 bullish daily closes, and as you can clearly see on the daily chart, we are bullish. The market is just going up. It's setting up higher highs and higher lows. So I don't want to come in after such a bullish daily close and say this is the top. But that's what a lot of traders do, and that's why they get in trouble. So for me coming in, I was only looking for longs. I was looking at a place where it made sense to put my risk and go with the direction of the market. So then we're going to jump on the 15-minute chart and I show you exactly what I saw. So for my first trade, I have my daily bias, I have my support and resistance lines. And if you don't know how to set support resistance, I do have a whole video about how I set up my support resistance lines. And it's literally the easiest way that you could do it. So definitely go ahead and check that video out. But as you can see, these blue lines are my support and resistances. And coming in, I was looking at an area where the traders were getting trapped and a liquidity grab for me to get in. We have this very bearish 15-minute candle. I know that a lot of the traders are now looking to short. We go to the next candle here. Boom. Now we see a liquidity grab, right? So this candle came, grabbed all of the liquidity from here and pushed right above. This is what I mean by trap. So before it turned green, as you can see, there's a wick down here. So this was at one point something like this. It came down bearish. So what did the traders do? They came in, they saw that initial bearish close, then they saw that big red candle forming. They did not wait for that one to close, right? So they jumped right in, and that's where they get trapped. So once I saw that liquidity grab and close, here I was looking for longs. And for me, I always like to get in on the break of structure, which means that I want to get in when the previous candle is broken. That shows me that there's a high likelihood of continuation. So then that's where I came in here. and I entered right over here. I set my stop loss right below the previous one. Now the tricky thing with yesterday's trades were that we are in all-time high market conditions. These are a little bit more trickier trades because I don't know how much more it's going to go. But what I did was to take off risk. I actually went in and put my stop loss at a 1-to-1 because I don't want to push it. I don't know where all the bear is going to come in. And I really don't have any higher targets because this is a price discovery zone. So for me, when this happens, I put my stop loss in a place that I'm confident with and I saw a trap, which is exactly what happened here. But I don't want to be too greedy. I don't want to put it, at 3R, 4R, even 2R is really pushing it because I really don't know why I would put that because there's really no targets or an area that the price was at before. So in these situations, I just keep it chill. I keep it simple. I just go for 1-to-1s base hits. And that's exactly what I did. I put my take profit right there and I was really confident with that because not only am I going with the direction of the trend, I'm also going where there was a trap, there was a liquidity grab. On top of that, we have the VWAP, which is this dark blue line, and a rising 9 EMA. So this just makes me very comfortable with this stop loss. So I know that even though it's a 1-to-1 trade, it is a safe 1-to-1 trade because I know that based on my back testing, based on my experience, I know there is over an 80% chance that this is going to work out. We're going to go ahead and play this and boom, literally in 30 minutes, my take profit got hit. I came out with a 1R trade right there. So after I took that first one, I didn't want to stay on the 15-minute time frame. I said that, I'm okay with that one trade. This is a price discovery zone. Now I'm going to look for a trap on a higher time frame because that would have another likelihood of continuing. So this is exactly what happens. Now I'm going to go ahead and replay the second trade that I made, which was right over here. Again, we have the direction to the upside. We clearly know that the price is in a bullish market trend. So now basically I was looking for the next trap, but this time on a higher time frame, and we got that right over here with this 30-minute candle, right? So at some point, this very bullish candle, you're gonna draw this. The traders basically came in trying to guess the top. They saw this wick here, then they saw this big red candle forming and they all jumped in. They all started saying that this is where the market is gonna go back and become a bearish trend. And of course they didn't wait for that candle to close. So again, what I did was I got in on the next breakup structure, which is right there. And again, because this is in a price discovery zone, I don't have any targets to the upside. I again went for a 1R trade because I don't want to be greedy. I don't really know how far this is going to go. I ended up putting another 1R trade right after this breakup structure. Let this play out and boom, our take profit got hit. And as you could see, as soon as the take profit got hit, we had a lot of rejection and the price even ended up going all the way here to the drawdown. So this is exactly why I was not trying to push it and go for a 2R, 3R trade, because when the price is in all-time highs, it's in the price discovery zone, I really have no targets. So in these situations, I want to go for base hits. I want to just get that 1R in here, 1R in over there. And when you add everything up, that's going to become something substantial, especially once you trade all of these on several funded and personal accounts. Taking 2 1R trades become a 2R day, which is pretty amazing in my opinion. So as you can see in both of these cases, I was looking for that trap. I was looking for that liquidity grab and align that with support and resistance as well as the overall market trend. So always remember, whenever you're taking an entry, whenever you are putting your stop loss, look for that trap, because if you don't see the trap, that means that you are the trap. So that's it for today's video. If you got some value from it, go ahead and hit the like button. If you haven't already, subscribe to the channel. There's going to be a lot more videos about day trading and about living a digital nomad life around the world. We are on our way to 1,000 subscribers, and at the moment we are at 202 subscribers, and I would love to have you on this journey with me, and I look forward to seeing you in the next video. Cheers.